Welcome back to the deep dive. You know, for so many families, one of the biggest financial questions looming on the horizon is how to tackle the ever-escalating cost of education.
It really is. It feels like it's constantly climbing.
Exactly. Whether it's thinking about private kindergarten, maybe specialized tutoring in high school, or, that dream university, these expenses can feel overwhelming.
Absolutely. People are definitely looking for ways to plan.
We're all looking for smart strategies, right? And today we're taking a deep dive into a powerful, maybe often underestimated tool designed precisely for this, the Coverdell Education Savings Account, or ESA.
Aquadels, yes.
And this isn't just about college, which I think is key. It's about a much broader journey of learning. So let's unpack how this could be a game changer for your family's educational planning. But first, before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, so to start us off, let's lay the groundwork. At its core, what exactly is a Coverdell ESA? What's the fundamental idea behind it?
Well, what's really fascinating here is that Coverdell ESAs are explicitly designed as a savings vehicle. They're there to help you accumulate funds specifically for qualified educational expenses. And that's for a designated beneficiary, usually, a child or a grandchild.
Okay, a specific person.
Right. And if you connect this to the bigger picture, it really emerged as direct response to that relentless climb in education costs across the U.S., which, as you know, has just significantly outpaced general inflation for decades now.
Yeah, no kidding.
So the government created this to offer a tax-advantaged avenue, a strategic tool, really, for families to actively save for these pretty substantial future costs. You can think of it like a dedicated education piggy bank,
Yeah.
but one that offers some pretty significant tax benefits if you play by the rules.
Okay, a dedicated piggy bank with tax benefits. So I think many people immediately wonder, okay, why not just use my regular savings account? Or, a taxable investment account? What's the big financial advantage here? Why go to the trouble of a Coverdell if you're already putting money aside for education?
Right, and that's where the true insight lies. It's a really critical distinction. So while contributions to a Coverdell ESA are not tax deductible.
Ah, okay, so no deduction now.
Correct. No immediate tax break when you put the money in. You've already paid income tax on those funds before you contribute them. But the real magic happens over time.
Okay, so no upfront deduction. That initial non-deductibility might make some listeners pause a bit. From your perspective, what's the most compelling reason despite that? Where does the real tax efficiency actually kick in with an ESA?
Right. This is where it gets really interesting. The most powerful advantage is that once the money is inside the Coverdell ESA, it grows. It earns income. Could be investment gains, interest, dividends, capital gains, and all of it. All that accumulation happens tax-free.
Tax-free growth.
Exactly.
Yeah.
And this tax-free growth is incredibly powerful, mainly because of compounding, especially if you start early over many years. And critically, when those funds are eventually distributed, taken out, and used for qualified educational expenses, both your original contributions and all those accumulated earnings are also completely tax-free.
Wow, okay. So it's not about the deduction today. It's really about that incredible tax-free growth compounding, maybe for decades, and then tax-free spending later on for actual educational needs.
Precise.
That really highlights the core financial advantage then. It's basically a double tax benefit, right? On the growth and the withdrawals.
You got it. Tax-free growth, tax-free withdrawal for qualified expenses.
So when you think about other common education savings tools, how does this compare conceptually maybe to something like a 529 plan? A lot of people know about those.
That's a great connection to make. Yeah, conceptually, in terms of that tax-free growth and the tax-free distributions for qualified educational expenses, it is indeed similar to a 529 plan. Both are powerful tools.
Okay.
However, the Coverdell ESA has this unique strategic strength.
Yeah.
It's remarkable flexibility for K through 12 expenses.
Ah, K-12. That's different.
Exactly. So if you're envisioning, say, private elementary school tuition, or maybe high school costs, or even specialized tutoring before college, the Coverdell offers a tax-advantaged path that, a traditional 529 didn't always cover as easily in the past. It makes it a really distinct strategic choice for that pre-college planning. but like you said, that flexibility does come with some guardrails.
Okay, guardrails. So what are those? How generous is the government with how much you can actually contribute to these accounts? I'm picturing a family, let's say Alex and Jamie. They've got two young kids. Maybe they're aiming for private school for a few years, then public, then college down the line. How much can they realistically put into these ESAs each year?
Right, good question. For a family like Alex and Jamie, the government is generous in who can potentially benefit, but there's a strict limit on how much per individual beneficiary. You can contribute a maximum of $2,000. That's per beneficiary per year.
2,000 total, or per kid?
Per kid, per beneficiary. So for Alex and Jamie with two children, they could contribute $2,000 for each child annually into separate accounts.
Okay, $4,000 total for them then.
Exactly. And this applies individually. So, if grandparents wanted to contribute for their 10 grandchildren, each grandchild could receive up to that $2,000 in their own ESA account in a given year.
Okay, so $2,000 per person per year. Now, that might seem maybe a little modest compared to, say, a 529 plan, which often lets you put in much larger amounts.
That's all we're, yes.
But I guess the real insight here lies in that compounding power you mentioned. If you imagine consistently contributing that $2,000 from birth, by college age, even with, say, conservative growth, those tax-free earnings could really make a dent in initial tuition or book costs, things maybe other accounts wouldn't cover tax-free.
Absolutely. Early and consistent contributions become disproportionately impactful because of that tax-free compounding.
Right. But does everyone get to contribute this $2,000? Or are there income rules? Like, could high-income earners be restricted from using this tool?
Yes, that's a crucial point, and it's one of the key ways Coverdells differ from, say, most 529 plans. There are income restrictions. They're based on your modified adjusted gross income, your AGI, and these limits can phase out or even completely eliminate your ability to contribute.
Okay, phase-outs. How do those work?
So, for unmarried individuals or those filing single, the ability to contribute starts to phase out if their AGI is above $95,000.
Yeah.
And it disappears completely once your AGI hits $110,000.
95 to 110 for single.
Correct. And for married couples filing jointly, that phase-out range is higher. It begins at $190,000 of AGI and ends at $220,000.
190 to 220, married filing jointly.
Right. So this design kind of suggests the government is aiming to make this particular vehicle most accessible, most impactful, maybe for middle-income families rather than, say, high-net-worth individuals, which is why some higher earners might find themselves needing to explore other options like the 529.
That makes sense.
And these limits, of course, they can change over time, inflation adjustments, new legislation. But the phase-out mechanism itself, that idea of an income limit, has remained pretty consistent.
Okay, so high earners might be limited or even phased out entirely. That definitely nudges them towards other strategies. Got it. So this gives us a good handle on who can contribute and how much. Now, let's shift focus a bit. Let's look at the other side. Who is this money actually for? The beneficiary rules. And are there deadlines on when it needs to be used? Because I understand these come with some important age considerations.
Indeed, they do. There are specific age requirements for the beneficiary, and they're quite important for planning ahead. The designated beneficiary generally must be under the age of 18 when the account is first established.
Under 18 to start, okay.
Right, so you generally need to set these up pretty early in a child's life. And then contributions can usually continue until the beneficiary turns 18. However, there's a really significant exception here to these age rules for special needs beneficiaries.
Ah, okay. How does that work?
Well, for them, those rules, the under 18 to establish and the use by 30 rule we'll get to, generally don't apply. It recognizes that educational needs for individuals with special needs can often be lifelong. So it offers much greater flexibility for those families, which is really important.
That is a really important nuance for families with special needs children. Okay, so for most beneficiaries, start early, contribute until 18. Once the money's in there and growing tax-free, how long does it have to be used? Is there a deadline for actually spending the funds? Because that tax-free growth is only helpful if you use it right.
Absolutely. And yes, for most beneficiaries, the clock is ticking. Funds in a Coverdell ESA must generally be used by the time the beneficiary reaches age 30.
Age 30, okay.
Age 30. Unless, again, they are that special needs beneficiary exception. If any funds are left over after the beneficiary turns 30, they have to be distributed. And here's the catch for those non-qualified distributions. Those leftover funds are typically subject to income tax on all the earnings, plus usually a 10% penalty on those earnings.
Ouch. So there's a strong incentive to use it.
Definitely. It effectively nudges you, quite strongly, to use the money for its intended purpose education within that specific time frame. And it's also worth just quickly reiterating that while, one person like a grandparent can contribute to multiple beneficiaries, each beneficiary must have their own separate account. And each separate account is still subject to that same $2,000 annual contribution limit per contributor, potentially from multiple contributors up to the overall $2,000 limit.
Right. So Alex and Jamie need two separate accounts for their two kids, each capped at $2,000 per year.
Exactly.
All right, so establish before 18, contribute till 18, use by 30, or face taxes and penalties unless you meet the special needs exception. That's a pretty clear timeline. Now let's move to maybe the most exciting part for many families. What exactly counts as a qualified educational expense? You mentioned earlier, broader than you think. What does that truly encompass? Is this just for college tuition, or can it genuinely be used for other levels of education, things a 529 might not cover as easily?
Yes. This is really a key differentiating factor for Coverdell ESAs. And it's where they truly shine in terms of flexibility. It's a significant advantage. Unlike many other education savings vehicles that are heavily focused on higher ed, Coverdell ESA funds are not only for higher education.
Oh, okay, this is big.
It is. The funds can be used for primary school, so think elementary education, grades 1 through 6. They can also be used for secondary education, like junior high and high school. And of course, they still cover higher education, college, university, vocational schools, trade schools.
Wow, that really does broaden its utility significantly. So for our example family, Alex and Jamie, this isn't just about saving for a future university degree 20 years down the road. It could genuinely help with, say, private elementary school tuition next year, or high school books in 10 years, or maybe specialized art classes, specific learning materials.
Exactly.
Can you give us a few more concrete examples? What kind of qualified expenses might this cover beyond just the obvious tuition and books?
Absolutely. So when we say broader, we mean it. It can cover things like tutoring services, uniforms, if they're required for attendance at a private school, fees for standardized tests, think SAT, ACT prep courses, or the test fees themselves.
Right.
It can cover special needs education services, which ties back to that exception. Even the cost of a new laptop or computer if it's required for enrollment or attendance.
A required laptop counts.
If required, yes. It can also include things like reasonable room and board, transportation costs, even supplementary materials needed for online courses. So it significantly expands the utility beyond just that traditional image of college tuition and textbooks. It offers real flexibility for a child's entire educational journey, from the early grades all the way through post-secondary.
That's fantastic. It truly offers a wide berth. Like you said, many people just think college, but that K-12 flexibility is a real strategic differentiator. Now, I've heard about something called the no double dipping rule when it comes to education tax benefits. What exactly does that mean in the context of Coverdells? Why is that important for families to understand?
Oh, yes, the no double dipping rule.
Yeah.
That's a crucial nuance, and you're right, it's often a point of confusion. It applies specifically to claiming education tax credits, things like the American Opportunity Tax Credit or the Lifetime Learning Credit. Essentially, the rule says taxpayers cannot claim one of those tax credits for educational expenses that were already paid for using tax-free distributions from a Coverdell ESA.
Okay, so let me make sure I understand this. Just to be crystal clear, you can't get the tax-free benefit from taking money out of the ESA and also claim, say, the American Opportunity Credit for the very same tuition expense you just paid with that ESA money.
Exactly right. You can't use the same dollar of expense to get two different tax benefits.
What's the underlying principle there? The government's reasoning. It seems logical, but maybe worth spelling out.
Yeah, it really boils down to preventing taxpayers from receiving multiple, overlapping tax benefits for the exact same expense. Since the earnings inside the Coverdell grew tax-free, and the distributions you took out for those qualified expenses were also tax-free, you've already received a pretty significant tax benefit right there.
Right, the growth and withdrawal.
Exactly. So if you then also claimed a tax credit for those same expenses, you'd effectively be getting a double dip of tax advantages on that same dollar. The IRS doesn't allow that. You essentially have to choose. Either the expense is covered by the tax-free ESA distribution, or you use it to claim the credit, but not both for the same dollar amount. It's about balancing the tax code's generosity.
That makes perfect sense. It's like, hey, we gave you this great tax-free growth and withdrawal benefit, so you don't get another break on top of that for that specific spending. Okay, so to really cement this in our minds, let's just confirm the tax treatment one last time. If you take money out of a Coverdell ESA, you use it for a qualified educational expense. Could be tuition, books that required laptop, tutoring, any of those broad examples we covered. What's the final tax situation on that withdrawal? Taxable, partially taxable, fully tax-free.
If the distributions from Coverdell ESA are used for qualified educational expenses, they are fully tax-free. Simple as that.
Fully tax-free, both parts.
Both parts. That includes both the original principal that you contributed, which, remember, you already paid tax on way back when you earned it, right? And all of the earnings that grew completely tax-free while inside the account. So going back to Alex and Jamie, if they put in, say, $10,000 for one of their kids over 5 years, and maybe it grew to $13,000 through investments, that entire $13,000 comes out completely tax-free when they use it for qualified education, like that private school tuition. It's incredibly powerful.
Wow.
Now, if, on the other hand, the distribution maybe exceeds the qualified expenses for the year, or if it's just taken out and not used for education at all, then the earnings portion of that non-qualified distribution is generally taxable as ordinary income and could be subject to that 10% penalty we talked about earlier.
Got it. Qualified use, tax-free. Non-qualified use, taxes and penalties on the earnings. Okay, so what does this all mean for you, the listener? We've taken a pretty deep dive into Coverdell Education Savings Accounts today, and I think it's clear they are a really powerful, tax-efficient way to save for a surprisingly wide range of educational expenses.
Definitely broader than many realize.
Right, from elementary school supplies and tutoring all the way through college tuition and books, you get that incredible benefit of tax-free growth and tax-free distributions. It truly is a unique vehicle, especially with that K-12 flexibility. It makes it a distinct consideration, maybe alongside or even instead of other tools like 529 plans, depending on your goals.
Yeah, and this raises, I think, an important question for anyone planning for education costs.
Yeah.
Understanding these specific tools and their detailed rules like the Coverdell ESA is just crucial for maximizing the benefits. It's not just about putting money aside, right? It's about saving smart.
Saving smart, yeah.
Knowing those income limits, knowing the age cutoffs for beneficiaries, understanding that no double-dipping rule with the tax credits. All of this stuff can significantly impact your financial planning for education. And ultimately, it affects how much you save and how effectively you can actually use those savings down the road. It's really about leveraging every available advantage for your family's future.
Absolutely well said. For families like, our fictional Alex and Jamie, this information could really be a game changer in how they approach saving for their children's futures, all the way from kindergarten to graduation, maybe even beyond. So we really encourage you to explore this topic further, see how a Coverdell ESA might fit into your own financial picture, or maybe share this deep dive with someone you know who might benefit. And of course, for more detailed support, additional practice questions, and video lectures on this and many other accounting and tax topics, be sure to visit farhatlectures.com. Until next time, keep exploring, keep learning, and keep asking those fascinating questions.